Today, we are diving into one of the wildest stories to ever come out of Wall Street. It's called the Turtle Trading Experiment, and it was all built around a crazy bet that you could literally create a millionaire trader from scratch.
And it all starts with this question, right? Is being a great trader something you're born with? Like some kind of natural talent, a gut feeling for the markets? Or is it just a skill, something that can actually be taught and learned by pretty much anyone who's willing to follow the rules?
Well, back in 1983, a massive bet was put on the line to settle this argument for good. The idea was as simple as it was bold. Take a bunch of total beginners, teach them a set of secret rules, hand them millions of dollars of real money, and just see what happens.
So that brings us to the bet itself. This was a classic case of nature versus nurture, playing out between two absolute titans of the trading world.
Okay, so in one corner, you had Richard Dennis. The guy was a legend, had turned a few $1,000s into over $100 million. But he insisted it wasn't some kind of magic. He famously said, "I could grow traders just like they grow turtles in Singapore." That's where the name comes from. But in the other corner was his partner, William Eckhardt, a brilliant mathematician who was like, "No way, Rich, you're a natural. You've got a gift that just can't be taught." And that argument, well, that's what sparked this whole incredible experiment.
So, the bet was on. Now Richard Dennis needed to find his turtles. He had to assemble his class of would-be traders.
So what did he do? He put these little ads in papers like the Wall Street Journal, and thousands of people applied. But here's the kicker. He wasn't looking for finance bros or people with economics degrees. Actually, he preferred people with zero experience, because he figured they wouldn't have any bad habits to unlearn. What he really wanted was a very specific kind of mindset, and he used this really clever true or false test to find it.
And this test just perfectly shows the kind of thinking he was after. So, big money is made buying at the lows? The turtle answer was a hard false. They were taught to buy things that were already going up, not try to be heroes and catch a falling knife. Risking a quarter of your account on one trade? Absolutely not. That was a huge red flag. The test was all about finding people who could ignore their ego, ignore the crowd, and just follow a system. No questions asked.
And I mean, just look at the people they picked. An accountant, a guy who designed Dungeons and Dragons-style games, a professional blackjack player, even a 19-year-old kid. This motley crew was the whole point. If Dennis could turn this group into killer traders, it would prove once and for all that the system was the star, not the person.
All right, so what were these magical rules? What was the secret sauce? Well, the turtles were handed a complete step-by-step system, something totally mechanical, designed to take all the emotion and all the guesswork right out of trading.
At its heart, the entire philosophy was something called trend following. Now, this isn't about predicting the future with a crystal ball. It's much simpler. It's about reacting to what the market is doing right now. If a price is breaking out to new highs, you buy it. Period. If it's crashing to new lows, you sell it short. You're just trying to catch the big, powerful waves and ride them as long as you can.
And to do that, they actually used two different systems at the same time. System 1 was for shorter-term trends, looking for a 20-day price breakout. But it had this cool little rule. If your last trade was a winner, you'd actually skip the next signal. This helped keep them from getting chewed up in messy markets. Then you had System 2, which was the long-term safety net. It looked for a 55-day breakout, and the rule here was simple. You take every single signal, no matter what. That way, they were guaranteed to never miss one of those massive life-changing trends.
Now, the entry rules were pretty straightforward, but the real genius, the secret weapon of the whole system, was in how they managed risk. And it all came down to this one little concept they called N. Just think of N as a simple measurement of a market's average daily wiggle, its volatility. And that one number, that was the key to absolutely everything.
So here's how they used it. For any trade, in any market, they would calculate their position size so that if the market moved against them by just one N, they would lose exactly 1% of their total trading account. That became 1 unit. So see, they weren't risking a random amount of money, they were risking a fixed, standardized unit of volatility.
And this is why it was so brilliant. It meant they could make a trade in a super wild market like crude oil, and it would have the exact same dollar risk as a trade in a sleepy, stable market like the Swiss franc. It leveled the playing field across the entire universe of markets. Absolutely genius.
Okay, so they had the people, they had the secret rules. Now for the million-dollar question, right? Did any of this actually work? Let's check out the results.
Oh, it didn't just work, it worked beyond anyone's wildest dreams. Over the life of the program, the turtles averaged an 80% annual return. 80%. Richard Dennis didn't just win his bet, he knocked it out of the park.
But, and this is the part that messes with your head, if you actually look at where those massive profits came from, you realize they were wrong most of the time. Seriously, the huge majority of their trades were either small losers or just broke even. Their entire fortune, all of it, was built on that tiny little 5% sliver of trades, the ones that caught gigantic trends that paid for all the little losses and then some.
And living that reality forced them to completely rewire their brains. It all came down to this mindset. A winning trade where you got lucky and broke the rules, that was a failure. But a losing trade where you followed the rules to the letter, that was a success. It was all about trusting the process, not the outcome of any one single event.
So, Dennis proved his point, big time. But what about today? What's the legacy of this thing? Could you dust off these old rules and use them in today's super fast computer-driven markets?
Well, the answer is kinda yes and no. If you backtest the original 20-day breakout system, it doesn't really work anymore. It's just too twitchy for all the algorithmic noise in today's markets. But the philosophy behind it? That's as powerful as ever. Modern trend followers just adapt. They use much longer-term breakouts, like 200 days, to cut through all that short-term static and catch the same kind of big, meaty trends the turtles did.
In fact, the original rules got so famous that other traders actually developed strategies to specifically hunt the turtles. There's one called turtle soup, which is pretty clever. Traders will wait for that 20-day breakout to happen, let all the turtle-style systems pile in, and then they bet on the breakout failing. It's a perfect example of how the market is always adapting and evolving.
And this really gets to the heart of the whole story. The experiment was never about a magic set of numbers. It was about proving that having a disciplined system for making decisions and managing risk will always beat shooting from the hip. That lesson is absolutely timeless, even if the numbers you plug into the system have to change over time. If you had to boil down this entire legendary experiment into one idea, into 3 words that created hundreds of millions of dollars, it would be this: process over outcome. Trust your system, execute it flawlessly, and let the results take care of themselves.
So that leaves us with one final thought. Think about it. Whether it's with your money, your health, your career, where in your own life is your gut feeling or your intuition maybe holding you back? And where could a simple, disciplined system, just followed day in and day out, lead to your next big breakthrough?